Welcome back to the deep dive. Today we're aiming to give you, well, kind of the ultimate shortcut to being financially informed. We're translating those raw, often pretty intimidating financial statements into insight you can actually use.
Yeah.
This deep dive, it's all about moving past just the basic numbers. We want to interpret what the critical financial ratios really tell you about a company's health.
And just as importantly, how they can sometimes mislead you.
Right,
Right.
exactly. That's crucial.
It's true. Raw financial statements are static data points. They're like a single snapshot in time.
Right.
Our goal here is dynamic analysis. We're trying to extract the story, the narrative, by calculating and interpreting four essential ratio categories:
Which are?
profitability, liquidity, long-term stability, and investor ratios. Those are the big four.
Okay. But before we start, crunching those numbers, we need to be clear about who this information is actually for. Who's really waiting for this analysis?
Well, it really boils down to three core groups, and often they have competing interests. First, you've got the shareholders and potential investors. They're, let's be honest, obsessed with return and the security of their investment, their equity. They're looking long-term.
Got it. Long-term view.
Yeah.
Then you've got the short-term creditors, like suppliers and lenders.
Exactly. And they're not so focused on return on capital. They care about return of capital,
Meaning?
debt security, and repayment.
Yeah.
Basically, are they going to get their money back next month? That's their main concern.
Makes sense. Very different perspective. And the third group.
And finally, management itself. They use this ratio analysis as like their main performance dashboard.
Okay.
It really dictates their strategy, shows them the trend, the level of the company's success or failure. These ratios, they're the language of accountability inside the firm.
Right. Okay, let's unpack that first category then. The engine of success, as you called it. Profitability ratios. We're focused on efficiency here. How well is the company actually turning its activity into, well, money? Let's start with the gross profit margin.
Okay. The margin itself, the calculation is easy enough.
Right.
Gross profit over sales revenue times 100. Simple percentage.
Right.
But the real insight, comes from analyzing the change in that margin over time,
Right.
over several periods.
Why the change?
Because if the margin drops, you absolutely have to ask that strategic why. Is the company, say, lowering its selling prices deliberately, maybe to grab market share, increase volume?
Ah, like that Ocean Motors example we looked at.
Precisely. That was a strategic choice.
Which is a valid strategy, sure, if the increase in volume actually offsets the lower margin per sale.
Correct.
But if the margin is falling because, I don't know, the cost of raw materials or labor is just skyrocketing and the company can't pass that cost increase on to customers,
Then you have a serious operational problem, a big one.
so you need that context. You got to distinguish between a strategic move and a, frankly, major warning sign.
Absolutely. And if we want to look for, let's say, the ultimate measure of long-term operational efficiency, we have to look at return on capital employed.
ROCE.
ROCE. This ratio, it really shows management's effectiveness in using the total pool of long-term financing, that's equity, plus long-term debt, to generate profit from operations.
And what's really fascinating here, I think, is that ROCE must always be benchmarked against the company's own cost of borrowing.
Always. That comparison is key.
Because if the company is paying, say, 6% interest to its lenders to finance its operations, but it's only generating a 4% ROCE,
Uh-oh.
yeah, they are essentially destroying value for their shareholders, for their long-term investors, just by holding those assets.
It sounds harsh, but they'd literally be better off liquidating the assets and just putting the cash in a high-interest savings account.
Wow.
That's the hard truth of it. But, to truly understand ROCE, you need to break it down. Look at its strategic components using something like the DuPont framework.
Ah, the DuPont analysis, right.
ROCE is fundamentally the product of two other key ratios. It's the profit margin multiplied by the net asset turnover.
Okay, now here's where it gets really interesting for me. Net asset turnover. That's sales revenue divided by capital employed.
Correct.
It's a measure of intensity, right?
Right.
How effectively is management sweating those assets, leveraging every dollar of assets to generate sales?
Exactly. And this framework, this breakdown, it reveals the fundamental strategic trade-off that companies have to make.
Go on.
Well, think about a high-volume food retailer, a supermarket. They have an inherently low profit margin, right? They only make pennies, maybe less, on each dollar of sales.
Very thin margins, yeah.
So to achieve an acceptable ROCE, they must have an incredibly high net asset turnover. They need to sell stuff quickly and constantly.
Yes.
Shift that inventory fast.
Makes sense. Volume is everything.
Right. Now, contrast that with, say, a highly specialized, capital-intensive manufacturing business, maybe building airplanes or something.
Okay. Big ticket items, lots of machinery.
Exactly. They might only turn over their expensive specialized assets once every few years. That gives them a really low net asset turnover.
But they survive how?
Because they command a very, very high profit margin on each sale.
Ah, okay. So the DuPont analysis shows you that two radically different business models
Like a supermarket and an airplane manufacturer.
can arrive at the exact same perfectly healthy ROCE.
Precisely. And that's why you just can't look at profitability or turnover in isolation. You need both parts of the equation.
Got it. Very clear.
So now let's shift gears a bit. We've looked at long-term efficiency. Now let's focus on the immediate ability to survive. Liquidity.
The pulse of cash.
Exactly. This measures whether a company can actually meet its short-term liabilities, pay its bills as they fall due.
And the standard test here is the current ratio, isn't it? Current assets divided by current liabilities.
That's the one. For decades, 2.1 was the magic number everyone quoted.
I remember learning that. 2 to 1 or better.
Yeah, but we've seen the modern norms settle quite a bit lower, maybe closer to 1.5.1. It reflects, I think, smarter management of working capital generally.
Okay, but let's challenge that basic assumption. I was always taught higher is safer. More assets to cover debts seems better. Why are you suggesting a high ratio could actually be suspicious?
Well, because liquidity is also a measure of efficiency, in a way. If that ratio is very high, say 4.1, it often means cash is just sitting there idle.
Not working for the company.
Right. Or inventory is piling up unsold in a warehouse. Or management is just way too slow in collecting money from its customers, those receivables.
So the company's maybe being overly conservative.
Could be. Why have $4 of current assets just sitting there to cover every $1 of debt coming due soon? That excess cash isn't being reinvested in productive assets. And think about inflation.
It's losing value every day.
Exactly. So a very high current ratio isn't necessarily a sign of strength. It could be inefficiency.
Okay, that's a really important nuance. So if the current ratio is our sort of general safety net, maybe we need a touter test, one that excludes assets that aren't guaranteed cash quickly.
Precisely. And that brings us to the quick ratio, sometimes called the acid test.
Acid test. Okay. How's that calculated?
We take current assets, but this time we subtract the inventory value first. Then we divide that figure by current liabilities.
Why exclude inventory? It's an asset.
It is, but think about it. If that inventory is slow-moving, maybe it's fashion-dependent or it's perishable, relying on selling that specific inventory to cover bills in the next, say, 30 days is extremely risky.
Right. You might have to discount it heavily to shift it fast, or it might just not sell at all.
Exactly. So the quick ratio is like the emergency wallet test. What cash do you really have access to quickly? It focuses on truly liquid assets, cash, near cash, receivables you expect to collect soon.
So what's a good quick ratio? Still aiming above 1.
Generally, yes, above 1.1 is preferred, but even a quick ratio below 1.1 can sometimes be acceptable, maybe in some very fast-moving retail businesses where inventory turns over daily. But usually below 1 suggests a high dependency on selling that inventory quickly or maybe stretching out payments to suppliers.
Okay. This whole short-term cash flow dynamic, it seems to be summarized really well by the working capital cycle, right?
Yes, that's a great way to visualize it.
That's the average length of time between paying for your production costs or inventory and actually receiving the cash from your customer. And the formula, if I remember, is the inventory turnover period plus the receivables collection period minus the payables payment period.
Spot on. Inventory days plus receivables days minus payables days. It's the cash conversion cycle.
And when this cycle stretches out, gets longer.
That's when trouble is usually brewing. Look at that Neville example we analyzed before.
What happened there?
Well, they saw their receivables days, the time it took customers to pay, jump from 65 days to a staggering 110 days.
Wow, almost 2 months slower.
Exactly. And at the same time, their payables days, the time they took to pay their suppliers, increased from 87 days to 102 days.
So they were getting paid much slower, and they were paying their own bills slower, too.
Right. That's the classic definition of stress. It signals really poor liquidity, and it often points towards a dangerous situation called overtrading.
Overtrading. What's that exactly?
It's when a company expands its sales volume really rapidly, but without securing enough long-term capital, enough finance, to support that growth.
Ah, so the sales look great on paper.
Yeah, revenue's booming, but the underlying finances can't keep up. The company becomes like a house of cards, desperately relying on those slow-paying customers coming through just so they can delay paying their own suppliers a bit longer. It's unsustainable.
Okay, that makes sense. Very risky situation.
Very. Now, shifting focus again, let's look beyond the short-term to long-term stability. Here, a key concept is gearing.
Gearing, also known as leverage in some places.
Right. Gearing basically measures debt as a proportion of the total capital structure. It defines the structural risk management approach of the company, how much reliance is there on borrowed money versus equity.
And this is that eternal financial risk-reward trade-off, isn't it?
Absolutely. Highly geared businesses, the ones relying heavily on fixed interest debt, they face a far greater risk of insolvency if things go badly. If profits dip, those interest payments still have to be made.
But the flip side.
The flip side is, if profits soar, the shareholders benefit wildly because those interest costs stay fixed. They don't go up with profits. So all the extra profit magnifies the return on the shareholders' equity. It leverages their return.
So management is making a calculated bet, really, using debt strategically.
Exactly. And to assess their ability to actually manage that leverage, that bet, we examine interest cover.
Right. How's that calculated?
It's typically profit before financing costs and income taxes, divided by the finance costs themselves, the interest payments.
And this tells you.
This is a crucial test of a company's ability to actually service its debt using its current operating profits. How many times over can the company pay its interest bill?
I always found this to be one of the most, sobering ratios if your interest cover drops below, say, 2 times.
Yeah, that's usually seen as unsatisfactory.
It means your operating profit is barely double the amount you owe your lenders just in interest for that period. That leaves virtually no margin for error if sales dip, does it?
None at all. And it certainly puts shareholders' dividends at high risk because lenders get paid before shareholders see anything.
Right. Makes sense.
And, the market is always watching these strategic decisions about debt and risk, which is why we should switch briefly to the investor ratios, specifically the PE ratio, price to earnings.
Ah, the PE. Everyone talks about the PE ratio. It's the current share price divided by the latest earnings per share, EPS.
Correct. And you can interpret this ratio as basically market's collective opinion. It's the consensus view on the future growth prospects of that share.
So if a company is highly geared, taking on lots of debt risk, but the market thinks management is navigating that risk successfully and growth is coming,
then the PE ratio will likely be high. Investors are willing to pay a high multiple for today's earnings because they anticipate much bigger future earnings, perhaps driven by that successful use of financial leverage.
So a high PE means high growth expectations.
Generally, yes, though it can also mean the market thinks current earnings are temporarily depressed. Context again.
Always context. Now, it's vital, isn't it, to remember that not every organization is aiming for shareholder profit.
Absolutely critical point. This brings us to accountability in, say, the public sector or nonprofits.
Right. They focus less on market valuations like PE or even ROCE in the same way. Their measure of value for money is often wrapped up in what's called the 3 E's.
The 3 E's, which are?
Effectiveness, did they actually achieve their stated objectives? Efficiency, did they use their resources well in doing so? And economy, did they keep their input costs low while achieving it?
It's a completely different mandate, focusing on service delivery or social outcomes rather than profit. But the need for analytical rigor for measuring performance remains just as important.
Okay, great point. So we've built this powerful analytical engine with all these ratios, but every machine has weaknesses, right? What are the blind spots? The crucial caveats that can prevent us from being truly informed? We need to talk about when and how numbers might actually lie.
Definitely. And the single biggest trap, arguably, is the fundamental reliance of traditional accounting on historical cost.
Explain that.
It means the figures used to calculate things like ROCE or gearing are based on what assets originally cost, maybe years or decades ago. It largely ignores inflation, current replacement costs, and the actual current economic value of those assets.
So you might have, say, a factory built in the 1950s sitting on the balance sheet at a tiny nominal value.
Exactly, which makes your capital employed figure look very low, and your net asset turnover, or ROCE, look artificially stellar.
And that makes comparing companies almost meaningless unless you know the age and condition of their assets, right?
It makes it incredibly difficult. If you're comparing a cutting-edge tech startup whose value is all in current IP and talent against an established industrial giant with old factories, Using historical cost ROCE just completely distorts the picture of who is generating more value today.
Okay, huge limitation. What else?
Well, we also cannot ignore human intent. We have to discuss creative accounting and its cousin, window dressing.
Right, creative accounting isn't necessarily illegal, is it? It's more about bending the rules.
It's the strategic use of the flexibility within accounting standards to present a more flattering or sometimes just a smoother, less volatile picture of performance.
How might they do that?
Oh, choosing depreciation methods that minimize expense in early years,
Mhm.
capitalizing costs that perhaps should be expensed, structuring transactions to keep debt off the balance sheet. Lots of ways. Often used to inflate assets or understate liabilities subtly.
And window dressing, how is that different?
Window dressing is more about timing. It's the careful timing of specific transactions right around the year-end reporting date to temporarily improve how the financial position looks at that specific moment.
Give me an example.
Maybe delaying necessary maintenance or depreciation charges until after the year-end date, or putting unusual effort into collecting debts from a few key customers just before the deadline to make the cash or receivables position look better, only to relax those efforts immediately after the books close for the year. It's temporary manipulation.
Okay, so context is absolutely king here, isn't it? Think about seasonal trading.
Huge factor. If a large retailer reports its financial position on, say, January 31st, right after the massive Christmas and January sales peak.
Their cash levels will likely be unusually high, receivables might be up from credit sales, and their inventory should be unusually low because they've sold it all.
Exactly. That snapshot, taken at that specific date, doesn't represent the average state of the company's liquidity or working capital throughout the rest of the year. You need to understand the seasonal pattern.
Right, and what about comparing different companies, even if they're in the same industry?
You have to be really careful about differing accounting policies. Even within the rules, companies have choices.
Like how they depreciate assets.
Precisely. Straight line versus reducing balance, the assumed useful life of an asset.
Hmm.
These choices can dramatically affect reported profit and the asset values on the balance sheet. How they handle R&D costs, inventory valuation methods, FIFO versus LIFO where allowed, it all impacts the numbers.
Makes direct comparison tricky.
Very. And finally, a big one when looking at large companies, consolidated statements. When you analyze the figures for big groups, companies that have merged or acquired others, you have to handle them carefully.
Why is that?
Because the group accounts will include transactions between companies within the group, intercompany loans, sales from one subsidiary to another.
Ah, things that aren't sales to the outside world.
Exactly. So a proper analysis of the group's performance requires careful adjustments to strip out, to eliminate those internal intergroup transactions. You need to see the performance delivered to the external market. Otherwise, you're just analyzing internal noise, not true economic activity.
Like in those examples we saw, Hoofoot acquisition or the Farrell Daily disposal, the consolidated numbers needed adjusting to see the real underlying trend.
That's the idea. You need to isolate the core performance.
Okay. This has been incredibly insightful.
So if we look back at our entire deep dive today, I think the core takeaway is really this. Ratio analysis is an indispensable tool. It's a diagnostic kit for performance.
But there's always a but.
It mainly provides context on the past. It's based on historical data. It's only truly useful, truly powerful, when you supplement it with qualitative context.
The non-financial information.
Exactly, the forward-looking stuff. Market share trends, management's stated strategy, environmental performance, social impact, governance structures, the quality of leadership.
You have to layer the numbers with the narrative, basically. Numbers without that external context, that story, are just noise, aren't they?
They can be dangerously misleading noise.
Yeah. So we've gone from raw figures to interpreting the internal engine profitability. We looked at the cash pulse liquidity. We assessed long-term stability and risk through gearing. And we touched on the market view with investor ratios. And crucially, we've learned how to spot some of the financial reporting tricks and limitations.
Indeed. And, we spent a significant time highlighting how ratio analysis is potentially crippled by its reliance on that historical cost information.
Right. The factory from 1950 problem.
Exactly. And this raises, I think, an important question for you, the listener, to consider as you interpret future financial reports. Here it is. In today's rapidly changing market, where technology often renders physical assets obsolete incredibly quickly, how much more meaningless does a concept like ROCE based on historical cost become, especially when you're trying to compare, say, a cutting-edge tech startup focused purely on current value and future potential against an established industrial giant valued primarily on assets recorded at historical cost decades ago. The data might be technically correct according to accounting rules, but is it actually leading you to the right conclusion about value creation and future prospects?
That's a really powerful thought to end on, something to definitely chew on.
Think about that next time you look at a balance sheet.